If you're a medical professional and you want to understand how market shocks and tax shocks can affect your portfolio and understand how to prevent them, you're going to want to stick around. That's our subject for today. And if you stay till the end, I'll show you a simple way to look at what you have and the risk involved. Do you ever feel like you're juggling too many balls at once, hoping none of them hit the ground? That's a bit like managing an investment portfolio. One wrong move and your finances could take a hit. But don't worry, there's a strategy that can help keep your portfolio steady even when the market's unpredictable and future taxes are unknown. So, welcome to Asset Allocation, shielding your portfolio from market and tax shocks. This is your go-to guide for understanding how asset allocation can protect your hard-earned money from the unknowns of market volatility and future tax changes. So, we're going to dive into the nitty-gritty of asset allocation, explain why tax diversification is key, and show you how to dodge some common pitfalls that can trip up even the seasoned investors. Defining asset allocation. Let's start with the basics. Asset allocation is the process of dividing your investment portfolio among different asset categories, such as cash, equities, fixed incomes, and alternative investments like you see on the slide here. So the idea is to balance our risk and reward by spreading our investments across these categories, depending on your financial goals, your risk tolerance, and your investment horizon. I'm going to say that again, your risk tolerance. So to me, that translates to what are you willing to lose in hopes of potential gains? So imagine your portfolio as a pie chart. Each slice represents a different type of investment. The size of each slice should reflect how much risk you're willing to take and how soon you're going to need those cash investments. So sounds simple, right? Well, it's more than just slicing up your investment pie. When we talk about a time horizon, the question is, what is your time goal for each of the investments? If you're trading in the market every day, that is a very different thing than someone who is contributing to their work 401k and isn't really monitoring it very often. So changes in the market, they're unpredictable. I want you to take a look at this chart. Fancy the Callan periodic table of investment returns, okay? So what it is, all you need to be able to do is see the colors. So this shows how various investment categories performed over the past 20 years. And the best way to understand this chart is try to pick out one color and see from year to year how it moves on the chart. So just to make it simple, let's pick that dark blue color. And when you look at that dark blue color, what you're going to see is that it's in different places on the chart every year. Okay, so any given category may be the best performer one year, and the following year, it might be one of the worst performers. So trying to pick the best performing investment category is really difficult because, one, no investment category performs well all the time. Two, different categories frequently move in different directions. We've seen that. Three, the leader in one year is often an underperformer a year or two later. Okay, so what does that mean? You got a stock tip, you're watching something on TV, stock tip, and it was super great this year, and then it bottomed out the next year. So it's unpredictable. And unfortunately, there's a better way to invest, and we're saying asset allocation. We'd also call it diversification. So finding the right mix, market risk and volatility, navigating the market volatility. So markets are like roller coasters. They're full of ups and downs that can leave even the most seasoned investors queasy. This is what we call market volatility. That's the words that we hear all the time in the news. But just because the ride gets bumpy doesn't mean we should jump off. So volatility is inevitable, but how you respond to it makes all the difference. An asset allocation strategy tailored to your risk tolerance, I'm saying your risk tolerance, can help you stay the course, even when the markets take a nosedive. For instance, if you're young and you've got a longer investment horizon, you might allocate a larger portion of your portfolio to stocks, which are more volatile, but offer higher growth potential. On the other hand, if retirement is just around the corner, you might prefer a more conservative allocation with a higher percentage in bonds or some sort of cash equivalents. So why you shouldn't panic. So one of the biggest mistakes that investors make is reacting emotionally to market declines. So while it's tempting to sell off our stocks after a drop, thinking you're cutting your losses, here's the important thing. When you cut your losses, you have locked in the losses and you've now eliminated any chance for upside in the gains to come back. The example of that would be, let's say it's a stock worth $100. It drops to $70 and you go, oh my gosh, I'm going to get out of that. I'm going to go ahead and lock in my $70, but then it goes back up to 90. You've now cost yourself the upside of that, which in this case was $20 because you got out. Okay. So markets are cyclical. They go up and they go down. Historically, they've always recovered from their downturns, often reaching new highs. And by sticking to your strategy and resisting the urge to panic sell, you give your investments a chance to bounce back. Remember, time in the market beats timing the markets. Okay, so why asset allocation and diversification matters? Well, it's not just a fancy term, it's a critical part of your investment strategy. So, by spreading out your investments across different asset classes, you reduce the risk that the decline in one area is going to sink your entire portfolio. So, this is especially important in a world where markets can be unpredictable and tax rates could change without much notice. So, asset allocation acts as a shield. It helps to smooth out the bumps in the road by ensuring that no single investment has the power to tank your portfolio. It's like having a safety net in a high wire act. So people ask me all the time, how much should I put in one investment? Okay. I usually say, how much are you willing to lose? And they look at me funny. And I said, my general rule of thumb is that I don't put any more than 5% of my portfolio in any one investment. Why? Well, because losing 5% of my portfolio isn't going to cost me the world. So my goal is not to be stressing about any one investment or any strategy. Okay. So while I say no more than 5%, it can be less than that. It could be 1%, it could be 2%, but no more than 5% in any one investment. Okay. So as we talk about asset allocation and diversification, I want to talk about taxes a little bit. This is a very strong point for me. So here is the history of the federal income tax in America. Most people say, I have never seen this chart before in my life. Where did this come from? Well, it's just a chart of the tax history of America. So if you look at the far bottom left, around 1912, 1913, it started off pretty reasonably, right? The red line is what the tax rates were. Now, keep in mind, I've got another chart behind this that's got all these different incidents of why they went up and what they did. But notice how those red lines are changing. Okay, and what I want you to keep in mind is that the percentage is one factor that can change. The income is the other. Okay, we understand the percentages. We talk about the percentages all the time. I'm in the highest tax bracket, da 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 da. But what we don't talk about is the income caps, which means what is the income range tied to that particular rate. So if you look at this chart, just take a look. I know this may be hard to see, especially if you're watching this on your phone, but look at how the red lines move. Look at how high the red lines move and look how fast they can go up from one year to the next. Okay. So if you look at this up around 1945, we've got a 94% number up here. And you say, what does that mean, 94%? Well, 94% was the highest federal tax rate that we've had in history. And what it means is that over a certain amount of money, 94 cents out of every dollar went to the federal government. So the story that I tell around this is around Ronald Reagan, previous president that we had, but also a movie star. Back in 1945, he was the president and he was making two pictures, as they called them in the day, two movies a year. And he was getting paid $100,000 a year for getting paid $100,000 per picture. Okay. So two pictures, $200,000. Why? Because here, this 94%, as soon as you made over $200,000, then you were paying 94% federal tax. Crazy. So 94% federal tax, California tax on top of that. And so what that meant at that time was that you were making negative earnings on every dollar over that cap. Okay. So notice this chart as it goes along. We got 94%, we got 91%. Okay. All of this. And we go to where we are currently and you go, well, that number doesn't actually look so bad. So we talk about taxes all the time. We complain about taxes and how high they are. But if you look at this chart, the average throughout our history has been 56.94%. And we are significantly lower than that right now. So I'm not going to get into politics or anything else because understand that regardless of what happens in politics or which party is in power, there is really no way that for our future, for our foreseeable future, taxes cannot go up. And that's what I'm hoping that you can see from this chart. So as we're talking about asset allocation, we're also talking about tax rates. Okay. So I used to say on here that we hadn't paid, we looked at recent years, we hadn't paid for the war on terrorism. Now, while we've had tax cuts along the way, and we've all enjoyed some of those tax cuts, different benefits and things that we've had, the federal, the spend, the federal budget has increased so much that we also haven't paid for COVID and all the things with that. So I do a whole presentation around that, which is pretty eye-opening, just talking about where we've been, where we're going. And it's pretty scary. But for me, this is the sleeper. This is the sleeper that people aren't talking about, right? We worry about a percentage. We don't necessarily look at the brackets, but the question is, what is this going to have to do with your retirement? Okay. So this is, if somebody were to ask you how much you had in your 401k, would you tell them the amount that you had on your statement? Well, you've got a silent partner who's going to take a significant portion of that in retirement. They're also going to tell you exactly when and how much you have to take out of your 401k, call it your 403b, and you have to pay the taxes on it. So this is a simple example. In this case, we've got a $100,000 balance, got a 28% tax bracket. And so your silent partner, called the IRS, their share in this case is $28,000. So the assumption here is it's a 28% tax bracket. So remember that we just talked about the stroke of a pen can not only change the percentage, but the income cap. And keep in mind that whatever you take out is considered income, right? A lot of people think, well, this is my retirement. Well, it's income that you deferred. So it's still income when you take it out, okay? And now you've got to pay the taxes on it. So I wanted you to look at how you're taxed using an example of a tree. All right, I've got these 3 buckets on the side. We've got taxable, tax deferred, tax free. And in small print there, it's talking about just the different things that fall into each of those categories. But if we're looking at this like a tree, what I want to say is if it's a taxable account, let's say this is a trading account that's in cash. It's not in a 401k, something you've got at the bank, whatever it is you're going to be taxed on that every single year. Every year, it's like cutting a branch off, right? So we're cutting a branch off the tree every single year, which means we're interrupting the compounding. If we're interrupting the compounding, in this case, I said $100,000, 9%, 20 years. Okay, I'm interrupting the compounding every year. At the end of 20 years, I'm going to have $340,000, okay, because I paid taxes on it every year. The next one on the tax deferred, this is our 401k, this is our 403b, this is our IRAs, okay? This is growing uninterrupted. So your tree is getting bigger. We're not cutting branches off each year. We're growing it into a nice big tree. But when we retire, we're going to start paying taxes on that, okay? So in this case, it's grown in 20 years now to $500,000 because we haven't interrupted the compounding, but we don't know what the tax rate is. Remember that previous slide and the tax rates and the unknowns there? That's the question. $500,000 looks great. Looks better than 340, but we haven't paid the taxes on it. So the last category here is we're talking about tax-free, or we'd say tax advantage. And what that means is it's something like your Roth. Okay, so if we're talking about Roths, now for the people that are high income, still pay attention because there's ways that you can do this outside of the Roth. And so the idea is that we're paying the taxes on the front end of it. So let's say that $100,000 is now $70,000. So we took $30,000 off in taxes, but now it's going to grow uninterrupted basically forever. Okay. This does not have the same rules as a regular IRA or a 401k. And so our 70,000 grew to 400,000. We paid the taxes originally on it, but there is no more tax bill. And that's the magic part here is we're saying, what can I do? Whatever it is, whether it's a Roth IRA or some of the other alternatives that I can offer, is what can I do to get the government out of my business, out of my taxes when I retire? Okay. And what I would say is that if you don't like paying taxes now, why do you think you're going to like paying them when you're retired and you're trying to manage that money? Okay. So even, I think a caveat here as we talk about some very high paid medical professionals is they may be trying to reduce that tax bracket right now because they may be in the highest bracket that they'll be most of their life. But we also want to be careful and look at that and say, is that my best move? And what's that going to do to me further down the road? Okay. So that's the difference. Like I said, tree taxable is cutting off a branch each year, tax deferred, grow the big tree, take the taxes off as we start taking the income out. And on the tax free is I'm paying the taxes on the front end and I'm not going to pay taxes on it again. Okay. Asset allocation. Don't forget about the taxes. If that's the only takeaway that you have today, it's a really important one that can change your entire financial trajectory for the rest of your life. Okay. So I'm not exaggerating there. It's changed mine. So we understand about stocks. We understand about bonds. We understand, CDs, things like that, but we're not talking about the taxes. Okay. So while we're talking about where your investments are in high risk, moderate risk, and low risk, as you see here by the slide, this is a portfolio I looked at recently for somebody. And what you can see is they've got a huge portion. This is a 401k. 401k is sitting there in the stock market. So that's high risk, 90% of it, and it's tax deferred. They've got some in the market here that's in cash that they're playing with that's high risk. Here's some money over here that's in savings. Okay. And we're saying no to low risk, right? 10% of the money that they have. But notice that this whole category on the bottom, they haven't paid any attention to. Now, the answer that I got from them at the time was I didn't know that I could play in that game. And what we proved was even in their company plan that they could play in that game, right? They made some assumptions because of what they found on the internet. And what I would have to say to you is you can go on Google, you can find out all kinds of stuff. I don't support Google as a good financial advisor, but keep in mind that all of your companies, the hospitals, whoever you work for, they have an individual retirement plan. They have to meet the criteria from the IRS, but they can have different rules. And so as I do my my not-for-profit work and do presentations for companies and for hospitals, a lot of times they have no idea of their own plan that they have. So your takeaway here is check with a plan that you have at work, see what you can do. You may find out that they've got a Roth. You may find out that even as a high income earner, you can still contribute in the Roth. Okay, get the taxes out of the way and do this. So that's the takeaway. Take a look at this. Now, if you're concerned that your earnings are too high to contribute to a Roth, there are some other very interesting things that we can do that will get you into the tax advantage category. So I'd be glad to talk to you about that. And that's what I've done for myself and my friends and my family. So if you had to say, okay, Alison, what would you do? What I've done since I've learned all this, since I left corporate America and I started doing this, is that I want the government out of my business as much as possible when I retire. And when I say out of my business, I mean taxes. So what I'm working on right now is to get everything that I can down on this bottom line. Okay. Now, keep in mind, I'll have Social Security, I'll have some other income, whatever that you can't control. But for the majority of my stuff, I want it down here. I don't want them telling me when I have to take it out, what I have to take out, and how much I pay them. So if you'd like to talk about that, I would love to talk to you. Okay. So this topic always generates a lot of questions. Risk and mitigating risk to get your hard-earned retirement. I want you to look at your retirement as a destination. Your retirement is a destination. It is a place that you're going to. A lot of people feel like retirement is so far out and they're not sure exactly what to do now. But then what happens is if you don't start planning for it now, you're going to be working way longer than you want to, or you're going to have to reduce your lifestyle versus having what you actually want at that time in your life. So you could push this all off, or we can actually hop on a call and have a conversation about creating a safe, optimized strategy so that you can retire when you want on the terms that you want. So do you want the 6-hour train trip with 10 stops, or do you want the express train that gets you there in an hour? You wouldn't want to plan a trip around the world the week before you left, so don't do that with your retirement. It's actually the longest vacation of your life. Click the link and let's talk about it.